Let's talk more now about what's going on in Europe, the stress tests, what they mean for the euro, as well as gold and world markets. Axel Merk is the president and chief investment officer of Merk Investments. His hard currency fund outperformed 96% of its peers last year. Axel, welcome back. Always good to talk to you.
Hi, good to be with you.
So first of all, let's talk about these European debt concerns. We were talking in the break, it seems like they took the summer off and now they're back. Do you think that there are really new concerns here, or is it people just taking a fresh look?
Well, people are taking a fresh look, and the Wall Street Journal had a big article on it, and they said the Bank of International Settlement shows that they're holding many more of these positions. The banks came back. Well, we just reported as we were told to. The good news here is that people are scrutinizing the numbers, forcing these banks to be more transparent, and ultimately they're forcing these banks to raise more capital. It's a very healthy process. It's a process that will have bumps on the road, but it's good that people are vigilant, and it just increases the transparency. It improves the environment, and ultimately they raise more capital, that making them more robust.
Do you think that there is still sovereign default risk at this point?
Well, of course, there are risks. There are also issues in the U.S. There are issues in many places around the world. The important thing is that we don't take the focus away. And from that point of view, you mentioned that Stiglitz said that the Europe engaged in the wrong bet. Well, Europe is not in the betting business. That's up to the Federal Reserve. And the Europe, they know they can't outgrow these problems. They have to tackle these problems. The EU Commissioner on Monetary Affairs, Olli Rehn, he said we need to have continuous stress tests. And that's absolutely the right thing to do. You need to be continuously applying pressures to these institutions and also to the governments. And we see that happening, a very healthy process. As a result, we happen to like the euro because everybody hates them. And at the same time, they're engaging in real structural reform right now.
Well, to Stiglitz's point, though, I mean, what about the argument that if you do all this austerity, it's at the expense of growth, and you need growth in order for these countries to climb out of the holes they're in?
Well, no, Europe cannot outgrow itself out of these problems. And Germany is showing the way how you can, with austerity, promote growth in the long run. But in the short run, we've seen it in the U.S. We get a cash for clunkers program. We get a blip up in the economy. And what we're left with is more debt in the end, but we don't get the sustainable growth. And so instead, you need to have structural reform. These wheels grind very slowly in Europe, but they're on the right approach. The pressure needs to remain. And then, yes, by all means, the weaker countries will have problems for many years to come. But the Eurozone as a whole is engaging in real reforms. The communication is improving. The management of the federal debt is improving. And the one thing that is not changing is they're not engaging in some federal body that is able to print and spend money as easily as in the U.S. And so ultimately, we'll have more inflation in the U.S. because we'll just patch up our problems.
Well, let's take a look at the euro a little bit more for a minute here. You said that you do like the euro now because it is on sale. On the other hand, we've had a bumpy ride, certainly, from the euro, up off its lows, but still it's come down in the past several weeks. What is going to be the catalyst here if these concerns persist for the euro to gain once again?
Well, I think Ken Fisher was on your program earlier. He phrased it right. People are chewing on the same problems. There is no news here. The news is that we know that there are issues, and they're being tackled. They're being addressed. There's no bombshell here. We know that some of the banks need to continue to raise more capital, and by all means, these stress tests that happened, they were okay, but just in the U.S., they were not tough enough, and so the private sector is taking over. Remember, when the stress tests were first released, the German banks did not release the holdings. Sure enough, those bank stocks dropped. The next day, they released more of their holdings. So now again, we'll see another wave of disclosure so that we can analyze in more detail of what the real risks are. And that's ultimately a very healthy process. On the government side, we need more transparency. And as long as the pressure is kept up, I'm not concerned that we'll get out of this. The problem really is if we were to print the money to bail everybody out, then we're not fixing the underlying problems and are just postponing them.
But, I mean, it seems like it's going to be a very rocky ride while these problems are being worked out, as you say.
Well, nobody said it's easy. I mean, the governments around the world have been spending too much money. But let's compare it, what's going to happen, euro versus the U.S. In the U.S., we're fighting the market forces. We're not allowing the homeowners to downsize. As a result, the government is trying to spend money. The Federal Reserve is printing money. And we'll do a much better job at that in the U.S., which means ultimately the U.S. dollar is going to weaken. And the euro should strengthen on a backdrop of austerity measures and far more stringent spending tools. And so as a result, but I don't think that the call for more growth is going to work. It might work in the U.S. temporarily, but in Europe you just don't have the population that's going to create the growth. You have a shrinking population, or at least a stagnant population. You cannot outgrow the problems in the Eurozone.
Axel, as I said, a pleasure as always. Axel Merk joining us to talk about the European debt situation.